Okay, let's take a look at example question on post-employment benefit, defined benefit plan. Okay, in this question, we have this company, SH Berhad, has a funded retirement benefit plan for its employees. Then the company's book for the year ended 31st March 2020 showed the following balances. Okay, so we have two accounts here. Okay, so the first one is present value of obligation. So since this is the amount appear on 1st of April 2019, so this is the amount that we consider as balance BD, beginning balance brought down. Okay, and this is 31st March 2020. So these two amount is amount that is shown as ending balance, balance carried down, balance CD. Okay, present value of obligations is actually the obligation of the company. So this is actually a liability account because the company has a liability to pay the retired employees this benefit. So this present value of obligation account as a liability account, it will have credit balance. Okay. And the other one is plan asset because at the same time, in order for the company to have enough fund to pay to the retired employees later, so they will accumulate fund every year. Okay, so the fund will be invested in a asset, plan asset. So this item, fair value of plan asset, is an asset account, meaning this beginning balance 450,000 has a debit balance. Okay, so the actuarial estimates for the current service cost was 36,000. Okay, the return on fund asset for the year was 8% and the average interest rate for the employer's obligation under the plan was 5%. Okay, and then during the year, a total of 40,000 ringgit was paid to the retirement benefit plan to fund the current service cost, past service cost and other funding requirements. And by the end of the year, 31,500 had been paid by the trustee of the plan to the retired employees of the company who were qualified to receive the benefits from the plan. Okay, so as you can see here, these last two paragraphs, but the second one here, the amount of total amount of 40,000, actually the amount paid to the plan. Okay, however, this 31,500 is the amount paid to the employees. So you have to be very careful, okay, which are the amount paid to the plan and which one is the amount paid to the employees, to the retired employees. Okay, so as the first step, you have to actually calculate the amount to be recognized in the statement of financial position as at end of the year, which is 31st March 2020. This part should be quite straightforward because you are given in this table how much is the balance at this date. As at this date, 31st March 2020. So you will just take the amount and bear in mind that this present value of obligation is a liability account and fair value of plan asset is an asset account. Please do not add the two amount. So what you need to do, you have to compare. Okay, so if now most of the time, we will start with present value of obligation. So we start with liability, 560,000, deduct with asset, fair value of plan asset, 550,000. You can see that we have balance 10,000, and this balance, the difference of 10,000 is called as liability because the amount of liability is higher than the amount of asset. Okay, so most of the time your answer should be retirement benefit liability. However, in certain situation, the answer should be the answer may be negative, meaning it is shown as retirement benefit asset. But bear in mind, if the amount is retirement benefit asset, referring to paragraph 64, the net benefit asset is measured at the lower of the surplus in the defined benefit plan and asset shilling. So if your answer is defined benefit asset, you have to be very careful because you have to consider this situation. Okay, you have to compare with asset shilling. Okay, and then after that, we calculate actuarial gain or loss from the retirement benefit obligation and plan asset. Okay, how to calculate actuarial gain or loss on present value of obligation? Okay, as you can see here just now, we have present value of obligation, we have beginning balance and ending balance. So let's start with beginning balance. As shown in this table, 450,000. So this amount of 450,000 is the beginning balance of the obligation of the company. So this obligation will increase with interest costs, current service costs, and past service costs. Okay, so that's why this amount will be added to the beginning balance. So how basically you calculate interest costs? Because 5% is given here in the question. This is interest rate for the employee's obligation, 5%. So you will calculate 5%, you multiply with beginning balance up here. So in this question, it is 450,000. Then you get 22,500. You add current service cost and you add past service cost. But remember, this past service cost must be the current portion. After that, remember the last paragraph, we have payment made to the retired employees. So since this amount, payment made to the retired employees, is the amount that will reduce the amount of obligation. That is why this benefit paid will be deducted. Okay, so after you deduct this amount, so you will get 477, and then what? And then you have to minus with ending balance. Sorry, there's a typing error here. This should be ending balance. Ending balance of 560,000. This is the one that you can get from the table here. So when you compare with ending balance, can you see here we have negative ending balance, negative figure. So this negative figure is considered as actuarial loss. However, if it is a positive, it is actuarial gain. Okay, this is the how to calculate actuarial gain or loss on present value of obligation. Let's move to the next one, planned asset. How do you calculate actuarial gain or loss on planned asset? Again, just now, you are given with fair value of planned asset at the beginning. So we will start with the beginning, which is coincidentally the same figure here between fair value of planned asset and present value, beginning balance of fair value of planned asset and beginning balance of present value of obligation. So beginning balance of this asset account will be added to the item that will increase planned asset. The first item is expected return. So the company managed to get this amount of return, which will increase the planned asset. So expected return, percentage of expected return given in this paragraph as 8%. Again, how do you calculate? Expected return will be 8% times beginning balance, which is 450,000. After that, you will add with additional payment made for additional funding for that current year. So payment for funding, planned asset is 40,000. Okay, sorry, here this one is please ignore. Okay, and then you will less with benefit paid to the employee, 31,500. Did you realize that this benefit paid to the employee is deducted from planned asset here, as well as deducted from present value of obligation up here? Okay, so ending figure will be 494,500. Then you compare, you minus with ending balance. Ending balance, so you will get here, you get the same, you get negative. When you total up, you get negative. So if this is negative, okay, it is considered as actuarial. Can this be the same as up here? Here is negative and here is also negative. Can we call it as actuarial loss? No, because this is planned asset. So this is called as actuarial gain. So if it is positive, it is actuarial loss. Okay, correct. This is actuarial loss. Are you all still follow? Actuarial loss if negative here, and then if positive, actuarial gain. However, here the negative is actuarial gain, the positive is actuarial loss. Can you see the difference? Because this is present value of obligation and this is planned asset. Okay, finally, how much will be recognized in statement of profit or loss? As we have discussed in the previous video, the item is called as defined benefit cost. So defined benefit cost consists of current service cost. Okay, for the current year, company incurred 36,000. Past service cost, there is no past service cost in this question. And then net interest on net defined benefit liability. How do you calculate this figure? So it is interest on present value of obligation, 22,500. This is the amount that you can get from this present value of obligation calculation, 22,500. And then you will less with interest income from planned asset at discount rate, which is the same percentage, which is 5%. Similar like you calculate just now, 5%. However, this 5% you will calculate based on planned asset. Planned asset, 450,000. Again, since the figure here is similar, so it is similar numbers. Okay, so it will result to 0. So the defined benefit cost total that will be recognized in the statement of profit or loss in this question is 36,000.